Good day, Toronto. Welcome to this month's episode of the Prime Properties TO podcast. So glad you could join me here. On this month, we have Ben Rabidoux sitting down with us to talk about what the hell is happening with the real estate market because stuff is everywhere. Now, I brought on Ben, who is the founder of North Cove Advisors and also Edge Analytics, because he gives a very different perspective of kind of what's happening in the real estate market because he is in the real estate space, the credit space. I think his Twitter description kind of says it best: credit, macro, and housing ninja. He really is. He understands a lot of the stats and the data and what kind of what's driving all the trends, right? So having a chance to sit down with them to talk about what's happening in the market from a perspective that isn't just mine or someone who's in real estate sales is very, very helpful for anyone who wants to understand what's happening in the market, right? So make sure you strap on. This is going to be a great one. We talk about a ton of things here. We talk about the recession that never was, which is the pandemic. We talk about how policymakers affect the real estate market, foreign investors, the rental crisis, the pandemic, I think the wealth tax. There's a whole bunch of stuff we tackle here that we get our opinions on. And it's just great to kind of bounce ideas and kind of theories of what's happening in the market with Ben. So make sure you guys strap on and listen to the entire thing. Now, for anyone who actually wants to reach out to Ben, Ben's a great follow on Twitter. I'll put his handle in the description below. And if you want any of the information we talk about here, you can check out edgeanalytics.ca. And again, can't speak. And the link will be in the description below for anyone who is driving, right? So without further ado, enjoy. Good day, Toronto. Welcome to another episode of the Prime Properties TO podcast. I'm so glad to join you here today. We got a special guest. We got Ben Rabidoux here from North Cove Advisors and his new company, Edge Analytics, which has some really, really sweet analytics for anyone who's in the investment space, real estate space, mortgage, anything you build it. So we're going to be talking about some of his new findings today and kind of share with you on what trends we're seeing, where the real estate market's going to be going. And there's no one better to have this conversation with than Ben. So please, Ben, say hi.
Hi, everybody. Thanks for having me on, Zen. It's a pleasure to be here.
Yeah, for sure. I'm glad to have you on. Do you want to give a little bit of background about how you kind of got to where you are? Because I find you have a very interesting perspective in the real estate space, right? Because you're not trading real estate. So you don't have this very skewed bullish perspective of the real estate market that every realtor has, right? You know, all of us are in trading in the real estate space, all are drinking the same Kool-Aid. Prices can only go up, right? So when I'm stalking you on Twitter, I like to use you as kind of like the bearish or even a different perspective. So having you on, I want to have everyone see and know kind of where you came from and know your background.
Sure. And I appreciate you saying that. One of the things I would say is anyone who's kind of followed my work over the years would recognize that, yeah, there's been times I've definitely been quite bearish or skeptical about the sustainability of some of the trends we were seeing in housing. Mm-hmm. My perspective has changed somewhat, and we can get into that and kind of what's driven that. But really, that started in 2019 after. You know, we had the stress test come in and we had the foreign buyers tax, and it really didn't do anything to dent the market. And we also saw our interest rates rise about 150 basis points off the lows, and all of those things together did nothing to dent the market. And more importantly, through 2019, we just saw this this unrelenting decline in supply across almost every metro in the country, to the point where by the beginning of 2020. We were at this incredibly tight market that was far tighter than anything we'd ever seen in Canada before. And I was saying, actually, to back up, like mid 2019, I was saying to my institutional clients, like, something needs to change here, because if we don't see something dramatic change, we're going to see like an explosive move to the upside in house prices. And so, yes, at different times, and I've certainly been skeptical or bearish. It's been hard to be bearish or even remotely skeptical the last couple of years because it's been purely a supply story. There's just been no meaningful supply coming online. So yes, that's been my perspective in the past. Now, a bit about me. I run an institutional research firm called North Cove Advisors. So my typical clients might be, institutional investors of various types. So whether that's pension funds, mutual fund companies, some hedge funds. And what I try to provide to them is just kind of a high level view of what's happening in the Canadian economy with a lot of focus on key risks. So things like housing, household finances. If you read through like the Bank of Canada's monetary policy report, which is usually not super exciting for the average person, but they sort of lay out a list of like, here are the risks that we see in the economy, right? And those risks are kind of what I focus on. And so I spend a lot of time thinking about what could kind of derail things. And housing and household finance have been kind of top of the list for years, right? And so I spent a ton of time on that. So that's on the institutional side. For years, I've gotten requests from people, like I'll periodically do Outlook calls for real estate boards or whoever it might be, but people that are in the real estate space. Mm-hmm. And they're always very well received, even when they're sometimes maybe less optimistic than kind of the consensus in the industry, because it's data driven, to your point, right? Like I do try to be true to the data, even if I'm not always right on my conclusions. And so I got a lot of feedback over the years, like, how can we subscribe? Do you have a product specifically for the real estate industry? And I just couldn't, because I just risked cannibalizing my institutional investor base. But finally kind of came to the conclusion that, you know what, real estate professionals across the country are sitting on this tremendous sort of frontline information, right? And if I could find a way to protect the integrity of the research, ensure that it wasn't widely redistributed, but then also attach kind of a survey to it so that I could pick your brain, for example, Zen, and say things like every month, maybe just say, well, what's your view on where house prices are going to be a year from now? What are you seeing in terms of website traffic, open house foot traffic, kind of forward-looking indicators, right? Well, that's very valuable information. And if I can do that across the spectrum of people that are involved in the real estate space, that actually becomes very valuable information for my North Cove clients, as well as for folks like you to kind of know how others across the industry and across the country are thinking. Mm-hmm. And so that was the kind of the genesis of Edge Realty Analytics, is to try to provide a platform to give top real estate professionals the kind of institutional level research, throw in some really neat infographics, which you've seen some of the infographics. I think they're pretty cool. I've got a graphics team that puts those together. They take some of the key concepts out of the reports, turn it into these marketing infographics that then my subscribers can share with their clients and prospects. They don't have to attribute it back to me. They get to look really smart, pass it off as their own for all I care.
That's what we love. That's what real estate love. Look smart, but not actually smart.
Well, but listen, that's the name of the game, right? You're just trying to look. You're trying to be smart. You're trying to be above the rest, right? And that's what I'm targeting. It's kind of that top fraction of 1% of people that in the industry that value that sort of information. So that's where I'm coming from.
Yeah, for sure. Like, I think anyone who's kind of watching is like, I don't have a lot of real estate professionals that watch this as well. It's very difficult to actually have like institutional knowledge and also like kind of data that's on the ground, because the two don't actually talk to one another, right? And if you
100%.
And if you have kind of your institutional data that's coming down and we can perceive it, and we also see what's kind of happening on trading on the ground, then that's the perfect combination of getting the macro and the micro, and which is what I've always tried to provide for my clients. Because when you got like, bank reports who are coming, like you said, right, RBC is like, XYZ is coming down, but it takes sometimes a while for it to trickle down to, the trading floor, in the real estate, or sometimes when the market's swinging up already, I'm always like, guys, the reports aren't saying it, but like in 2 months, you're going to hear like crazy multiple offers. And I was saying this in November. So having that kind of bridge between the two will make it so that everything that reporting out there that's more time sensitive gets to the people out there. That's why I actually really, really enjoy what you're putting together for Edge Analytics.
No, I appreciate that. And it's interesting you say that, because one of the things I've always been fascinated with is like one of my value adds for my institutional clients is that I do talk to a bunch of frontline contacts such as yourself or people in the mortgage space. And it was always interesting to me, like one of the things that my institutional clients love to do is, this is obviously pre-COVID, but they would come to Toronto and they would just want to spend a day talking, not to the banks, not to economists. They just wanted to talk to, like, well, put us in front of some smart mortgage brokers, some smart realtors that specialize in this, some smart realtors specialize in this, some developers, insolvency trustees. Like, we just want to get a feel for what's happening that's not covered in kind of the economics report that you're going to download from whatever RBC, right? And you're right. There's huge value in that sort of frontline intelligence.
Yeah, I mean, even for like any kind of investors out there, I'll give you an example. We were telling all our clients in November, like, it's time to buy condos. It's time to buy condos. They're undervalued. It's going to go up. And here we are in June. Prices are pre-pandemic and even higher now, right? They got it like
that was a good call.
Yeah,
so was that basically, your thinking on that was basically as soon as the vaccines came out, you saw, there was more or less an end to the pandemic. And at that point, prices were off probably 10, 15% in the downtown core sort of thing. Is that how you were thinking about it?
Well, that's, I think, everyone's initial thought process. When I looked at the data, I try to do a comparison of like what the 905, freehold market looks like on average and what a
Mhm.
416 condo price would be. And there's usually like a multiplier, right? So the multiplier has always been like 1.5, give or so. So when the condo prices were, call it $500,000, the 905 detached was like $1 million. Or sorry, like like 800, 900. And when they became 700, there was about $1 million, give or take, right? And it's always been a consistent 1.5 times ratio. So I use the 905 detaches because a lot of our clients, like, they take money out of their house to buy a condo, right? So when I saw the 905 detaches ramp up like 30%, and it was I think in November, it was like 15%, it's like something has to give. The condos aren't going to stay this way, right? So they're always going to put a floor to it. They're like, oh, these things are undervalued with interest rates so low. I'm like, they're definitely going to go up in price. So I just tell them, like, look, if you have a good cash flowing base on your portfolio, you can sustain the negative with the rents that were, rents were kind of low. So you're like minus $400-500 at the time. And then we just told them to buy kind of like no rent control buildings so that when things change in a year, you can increase the rent. And the clients who kind of took up our advice were like, they did pretty well. So like, that's kind of,
That's smart. That's a smart view.
yeah. So like when I kind of look at data, kind of like, and some of this I attribute it to you too, right? Like for anyone who's kind of watching, like I'm an avid lurker on Twitter. That's how, I get Ben's data. but like when we look at this stuff, right? Like it's not just all my information, right? Like a conglomerate of things. And that's what I'm Ben on. So when you mix kind of what you see on the ground, like no one is buying stuff and sellers are desperate, we're able to get deals. So when you mix that together, that's kind of how I came up with the thesis, right? And some people will believe it, some people won't, right? And it just kind of why I love what you're doing, because if we can put better data out there, then those who have an information advantage are going to, come out on top, right? And that's kind of what we want for all our clients.
100%. And if I could just speak really quickly to the actual product itself. So the Edge Analytics reports are sort of 2 per month. I think you've had a chance to see both of them, but one is like a metro level deep dive, and we spend a lot of time looking at the granular trends in the big metros like Toronto and Vancouver, for example, but also to some extent Alberta metros and Quebec metros. Yeah. And then the second is kind of what we call the Edge report, which is just a big report of all the really relevant macroeconomic indicators from the past month, and then trying to tie that together with what it means to home sales and mortgage rates and all this stuff. And then periodically we'll do some special reports. I know I sent you one looking at understanding how housing did so well during the recession, right? So all of that, you're right, all of that gets covered every month in the reports.
Yeah, that was a great headline. Like we do a lot of headline writing. The depression that never was.
Yeah. Well, it was, right? Because it was funny. If you go back to this time last year, I mean, we were staring into an abyss, right? It was, I mean, not so. Now we're into June, right? But when you remember back to that kind of March, April period, like it was really scary, right? Like really freaky.
Yeah, it was really. Yeah.
Yeah. And like nobody had a clue. And it's funny, you get like everybody's dunking on CMHC now for kind of their, what turns out to be just wildly wrong forecast, but like -9% to -18% house prices. But I mean, really in the moment, could you fault them? Like you're looking at this, like that was, to me, that was like the rational outcome. You had to think it was going to end badly. I think everybody did, if they were being honest.
Yeah, if anyone said that they were going to see like, a face ripping 20% in like the end of the year rally, it's like, you're insane. No one would have believed it.
Nobody called that, right? But so everybody's dunking on CMHC now. And I'm like, guys, like if there's ever a time to cut forecasters some slack, it's like that time. Yeah, because there's just too much going on to make any real, bold predictions.
Like my whole thing on it is like, I think people who do it, like the intention as well, right? They may not be right, but those who kind of get hurt financially because they've listened to this crown corporation's advice can be upset, right? Like if you were on the fence and you couldn't buy something and then all of a sudden prices went up 20%, now you went from, like a 2-bedroom condo to a 1-bedroom condo, or like you went from a detached to now like a freehold town. Like I would be really upset too.
Yeah. I mean, it's tough, right? Because I mean, you feel for the people that, it's a terrible idea to ever do this, but the people that sold thinking that they'd buy back in later. And you saw some of that, those comments, hard to know how real it is, but there was definitely, you saw some comments under some of the CMHC postings along those lines. I mean, that's just a horrible idea to do that to begin with, but the idea of flagging risk, right? That is what CMHC is meant to do, right? They're trying to manage a pool of risk on behalf of Canadian taxpayers. And that's how they have to think. They have to think in terms of what's our worst case outcome, right? So they're always going to lean a little more bearish because that's what you're kind of trusting them to do, is to be thoughtful and prudent in that.
And I think it's great to have these different perspectives, right? But we're in a generation where it's just like, quick Instagram headlines and stuff like that, right? You see a picture or an infographic and you think that's news, but you don't read the whole thing. So you either have people who are like driving headlines of like crazy predictions to get eyeballs, and on the polar opposite. So there's no real like critical thinking that's out there anymore. And that's the problem I find, right? Like when I talk to people, they're like, oh, I read this headline on CP24, like prices are coming down. And I'm like, have you actually looked at the actual stats? I'm like, sales are down month to month, but prices are at all-time record high, right? I'm like,
Right.
that's what's missing in this. And that's kind of what I think you and I both tried.
Right. Or you're right. Or even along the same lines there. I mean, we've seen now seasonally adjusted house price or home sales, I should say, in Toronto and Vancouver come off almost 30% from the March peaks. And you see a headline like that and you're like, wow, that's scary. Dude, if you pull up that chart, I mean, that March peak was so absurdly high, right? And way out of line with anything we've ever seen. So to pull back a little bit off of that, I mean, this is still an incredibly strong market. And more importantly, if you look at the available supply and you frame it in terms of like, well, what are months of inventory? That's always my preferred measure of kind of the balance of the market, right? It's like months of inventory across segments in all the major markets in Canada are still about half of what their normal levels are.
Correct.
So this is still a very tight market, even if we've kind of come off the incredible frothy levels of March.
Yeah, March was bonkers, I would say. Like everyone was just throwing money at things. We had to talk to some clients. I'm like, you don't want to pay this kind of money for this house. You're not going to get the appraisal. Like you're not going to get the appraisal on this.
Yeah, but it's funny you say that because I don't think I heard, because I was always asking my mortgage broker contacts about that. It's like, how is this stuff appraising? It's like, you hear these stories where it's like, yeah, the one down the street sold for 1.1. And then literally 2 weeks later, this comparable, which should have sold for around that same price, sold for 1.3. And it was like a case where you had like 15 bids and 14 of them were all clustered around like 1.1, maybe 1.2. And then you get one that's like way above the rest. And you look at that, you're like, how does that ever appraise, to your point? But they always do. Like I didn't hear any. Did you have anybody that had issue with appraisals?
No. We try not to go out of the norm, right? When we see prices going crazy, we're like, look, just have a little bit of buffer just in case, right? So we're always like, if you sell and you have a 60, 90-day close, there's a very likelihood that the next person that buys this place is going to pay more money. So my, ground level trading logic and whether people want to decide on it is, look, you buy this place for 1.1, you paid 50,000 more than say everybody else, right? But if you have 15 offers, 14 of the other people didn't get the place. The next one that's similar to this, you still got 14 people that want to buy it, right? And is the seller going to want to let it drop for less than what we just paid it for? Call it like 50 over what was us, like 1.50. The next guys are like, oh snap, we're going to pay more, right? And that's how it's never kind of underappraised. But the thing you have to worry about in those situations, and why we tell our clients to have a little bit of money left over, is kind of like, if quote unquote some of the bears are saying real estate's a Ponzi scheme, you don't want to be the one left holding the bag. You don't want to be the last one on the appraisal before the market dips.
We saw that in 2017, and where it gets kind of scary is we get these rapid run-ups in prices, and then all of a sudden the market cools very abruptly, and you've got all these people that are caught short where they bought a house without selling theirs previously. And you're right, that's always the risk, especially when you get into these really frothy markets. But it's hard. It's really, at this point, it's hard to see a hard stop like that, like what we saw in 2017. Because I just don't think, I mean, we can get into this, but I just really don't think regulators have the same appetite for curbing this market that they did back then.
I mean, well, we can go many, many ways on this topic, right? Like, do we talk about policymakers? Do we talk about economics? Like,
well, let's do, well, the two of them are combined, right? You can't separate the two. So, well, the issue is this.
Yeah.
Okay. If you flash back to 2016, 2017, it was a story really of two metros, right? It was Vancouver and Toronto. And if you look at kind of the national house price charts, you overlay it by city, it's like you have these two cities that made these huge spikes and they dragged the headline higher, right? Mm-hmm. And so when you're in a situation like that, you can have these sort of targeted regional measures like the foreign buyer tax, right? Which, regardless of how you feel about the potential impact of foreign investment, it did a lot to upend the psychology, right?
Oh, 100%, yeah. 100%.
And so, right. And so you saw very quickly then places like, let's say, York region, the single family market fell quite abruptly after that, right? But that's a very targeted regional approach. You also had OSFI come in, bring in the stress test. That had a very pronounced effect on credit, which we saw, like mortgage growth just kind of tumbled after that.
Yep.
But you also had a very robust economy at the time, right? And that's fundamentally the difference with what we see today. So when you look at how much of our economy right now is being driven by housing, both directly and indirectly. So directly, if you look at, so one of the measures I track pretty closely is called residential investment. And this is new housing construction, renovation, and then what are called transfer costs. So whatever, legals and taxes and various realtor fees, et cetera. And those three components combined normally are around kind of 5-6% of GDP, right? And in the previous kind of cyclical peaks in the 70s and again in the 80s, they got up to like 7%, right? Well, today they're almost 9.5%, which is just like an absurdly high number. And when you look at how much of GDP growth, let's say since 2018, have been driven by that one component of the economy, it's almost half, right? Yeah. So then you say, okay, what policymaker in their right mind is going to dramatically cool housing at a time where the unemployment rate is still 2.5 percentage points above pre-COVID levels? And really housing is the main thing driving this economy, right? Directly, but then also indirectly through how it supports consumption. Because you and I were talking about this, right? Like so the average person that owns a single family house across the country is $180,000 richer today than last year at this time, tax-free, right? Yeah. Just from owning a house.
I'm pretty sure you're the one that started that headline.
That's true. It's 100% true.
There's news articles saying like, why bother working? You're making $180,000 on your house. I'm pretty sure that came from your data.
100% it did. Yeah, it did. And so, but you can't argue that. So let's say, so now you think about what's the propensity from people when they have that? Well, the propensity is oftentimes they'll do a refinance. Not everybody, but there's some component that's going to go, geez, wow, we got all this extra money. You feel wealthier. You're more confident. Maybe you take some out and you buy the things you always wanted to buy, maybe a boat or take a vacation, or you buy that investment property like we were talking about. Yeah. And so it kind of feeds back into consumption that way, right? Mm-hmm. And so no policymaker, especially, you got to remember, like this is likely an election year, right? Once the pandemic's behind us, I suspect you'll see the government announce an election this fall, and they're out of their mind to try to cool housing right ahead of an election, right? Yeah. So it's just not the same regulatory environment. And to get back to my original point, even if they wanted to, there's no easy targeted measures to cool housing when every little tiny part of the country is booming. Like literally everywhere in the country is booming right now. So it's not like you can bring, like, is a foreign buyer tax going to matter for, like, I don't know, Sarnia? Like really, like, it's just not going to matter, right? So like, what do you do to kind of try to take the froth off?
Sorry to
well, I'm not trying to defend Sarnia, right? But like, I mean, I live in a place that's kind of, a couple hours out of the GTA. And like, there's no foreign buyers here. Like that narrative is not a thing here, right? So, I mean, if they brought in a foreign buyer tax, we'd all be like, okay, whatever, like, who cares, right?
It made no difference. And this is what I always try to spell to people, right? Like if, I were to buy a place and I use my legal name, which is my Chinese name, I look like a foreign buyer, but I'm Canadian, right? And even trading from the ground level perspective, a lot of the times, like the foreign buyers just tend to buy pre-construction because they're trying to store the money here. They're not buying resale properties. That was only like a thing for a brief time in 2016. Tiny little blip.
Yeah, I mean, that's consistent with what we've heard. I mean, I have mixed thoughts on this. Like, I do think there's something to the narrative that, there's a lot of foreign capital flows coming into Canada.
But I think it would be, my guess would be that it's for people who are immigrating here or the kids who are here on a visa.
Right. Yeah. So you hear that's where it gets tricky, right? Like, how do you differentiate foreign capital versus a foreign buyer, right? So if you have let's say a student that's here on a work permit, well, they're technically counted in the domestic Canadian population, right? Even if they don't have full. So is that a foreign buyer or is that foreign capital backing a proxy domestic buyer, right? And those are two separate issues, and that's not easy to parse those things. But I would say, like, look, the government would be wise to, I think at the end of the day, we need in Canada a beneficial ownership register, right? Like, so, yeah. I don't think that, if you're, let's say, a Chinese national that's got some corrupt, illicit gains and you want to park it somewhere, like Canada for years has been a very easy jurisdiction to do that. And I just don't think that's good from like a social fabric perspective. So, we should be able to find out, not we, but I mean, like the authorities ought to know, okay, if you own this $7 million house in West Vancouver or whatever, and it's in a numbered company, well, who's the beneficial owner? Yeah, right. Exactly. And if it's some connected politician out of China, well, like, I think there should be some questions,
There
right?
100% should be. Like, I know people who have open corporations with their kids and they would funnel money through. And before crypto was banned in China, they would use crypto to transfer money through. Like,
Right.
I know a lot of these things. Like, I got people like,
Yeah.
hey, then I got the guy who'll hook you up with your client. Like, no, I don't want to do it. But like, I know they exist, right? But it's not,
100% they do.
yeah, but it's not as much as I think some people would think, but they definitely do exist. And for the government to target kind of like this small segment, I don't know what it was about, but I'd say it's sub 5%. And to look like they're doing something is to all they're going to want to, all they can do, look like they're doing something. Like, they haven't targeted the actual underlying reason.
Right. Well, okay. So that gets back to the main point. The main point is that we've underbuilt single family housing.
100%.
Okay. So that is the fundamental. Now, but then if you overlay on top of that, this incremental marginal buyer that's not domestic, isn't here producing goods and services and enhancing productivity in the economy, that becomes a problem. Like, I that's my belief. Now, look, as far as I'm concerned, it's one of those things where it's like, well, if we can do it, why wouldn't we? Right. And to me, like, a beneficial ownership registry is just like the easiest, lowest hanging fruit that's like should be completely uncontroversial, right?
Yep, I agree.
And so like, and if that serves to kind of flush some of that illicit capital, that can't be viewed as a bad thing, right? And then if conversely, if it frees up some of that single, but you're right, it's that capital is primarily in the luxury area.
Yeah, but the question we should ask is, why haven't they done it? That's my question.
Well, okay, so here's a great. Have you seen Sam Cooper's book that he's written? It's okay. So Sam Cooper is this great. He's the guy that was doing all the research and the reporting out in Vancouver on like the money laundering through the casinos and stuff.
Oh yeah, okay, I know that.
Okay, and so that guy, like, just to be clear, he single-handedly advanced the regulatory agenda in BC in terms of them bringing in, curbing some of the money laundering and all this stuff. His book is absolutely mind-boggling, right? And so, when you read that, like, you can't help but think like, yeah, this is a bigger issue than people think, and it goes way up the chain politically. It's something else. I would encourage any of your readers or any of your viewers to check out that book. It's called Willful Blindness. I got it sitting around here. If you grab it,
we'll put a link in the description below for who's kind of listening and want a piece of that.
It's great.
I do agree with you. Like, when you ask these questions about why certain things aren't done, you're like, then no matter how much people are crying or complaining about it in the news headline, like, it's up to the government to do something about it, right? Like, another point to add on to why they haven't done it, like, if we really wanted to kind of curb the real estate demand that, like, Canadians have and help first-time buyers get in the market, why don't we just eliminate investors or make it more difficult for them, right? Like, I'm an investor, right? And if you told me, like, I've been saying this all the time, like, just all like second, tertiary, quadruple, whatever, like, additional properties, make it the down payment much bigger. It's like that in Hong Kong, like, if you buy your second property, if you're out of province, you have to have a 30% LTV, which is like 70% down on 30% lend on like a $1.7 million apartment. So like, it's hard to get another property, but the fact that they haven't changed it and kept it at 20%, that's just another thing where, like, it's such an easy thing to do. Why don't they do it?
Yeah, well, that's interesting you said that. So so in the early days of the pandemic, we actually saw at least one bank come out and say, we're going to restrict mortgages. If it's an investor, we want to know that the capital for the down payment is coming from saved sources as opposed to borrowed off a HELOC or a refi, for example.
That bank has reversed the rules really fast, though.
Yeah, they did. Yeah, totally, they did. But I think that sort of tells you how they're thinking about potentially, if they were to move in that direction, what they would do, right?
Yeah.
The issue for me is, for the longest time, we weren't really building purpose-built rentals in Canada. Now we are today. We're building a lot of them. A lot, yeah. And so, a lot. You're right. Yeah, and so it's less of an issue today, but for the longest time, the rental supply was coming from the average kind of the investors you're dealing with, the mom and pops, the retail guys. That's right. But my concern with that, and one of the things I think that would be wise for the government to address, is like, you end up with a situation where you get like security of tenure, right? Where it's you end up with, okay, if prices run up 20 or 30%, well, maybe I'll just go ahead and sell this, right? And then it leaves the tenants really screwed, right? And I don't want to sound like I'm, totally unsympathetic to the realities that being a landlord is not easy, and you get screwed by the landlord tenant board, right? And that needs to be overhauled for sure. But I do think there needs to be a balance there where it's like, listen, if you're going to put yourself out as an investor and you want to provide shelter for people, you need to be in this for the long term. Like there should be minimum holding periods or some sort of like, additional taxes if you're an investor, but you're in and out in a couple of years and you kind of screw these. But the flip side is you need to overhaul the landlord tenant board and make it much less tenant friendly where tenants can just screw landlords. There's a balance that needs to be struck there.
Yeah, I completely agree with you. And like, I can actually share a really, really good story with you. And a lot of people appreciate this. So we have a lot of clients and we started investing like way back ago, right? So we used to be able to buy a house for like $300,000, like in Oshawa and Hamilton.
Way back.
Yeah, way back. Yeah, we're dating ourselves now, right? And you could get rent of like $1,500 and the things will break even, right?
Yeah.
And then slowly as time changes, we had to add additional suites. And lately in say the Durham region, there was like a huge spike everyone was talking about it because a lot of people from Toronto moved there because it's like a 45-minute drive. The GM plant's coming back on and everything. So I've seen a huge exodus of people selling their properties. So these are properties that are even tenanted, right? Some of them are on month-to-month leases and tenants don't understand that. So, end users, whether it's real or not, are coming in and getting these people ousted, right? And when I buy these like vacant properties, like legal 2 units, like we do it the proper way, the amount of applications I'm getting where it says my landlord has sold is through the roof. Like in one of the properties we have, I would say it's like an A++ area, 3-bedroom, 1 bathroom, 2 car parking in a nice area, listed for $2,400. We had 68 applications in one day.
Wow.
And I go through them. So like we have a system for this, right? And I would get an idea of like what their story is, why they're renting. And I would say 40 to 45% of them said their landlord have sold. Now, here's the sad thing. When I come and I chat with them, I show them the property. They're like, oh, I got to leave them. Then I ask them, what were you paying in rent previously? These guys were paying for $1,500 all inclusive for a whole house. So now, because everybody in the landlord wants to cash out, right? And whether it's tenanted or not, they're like, forget it. I'm going to get my money. I don't care, right? And that's what happens in a hot market. All of these tenants are forced to leave and vacate. And now all of a sudden their housing cost has like increased by 40%. Like I'm sympathetic to that too, right? But I have to represent my clients to, make sure it works. But that's what's happening when.
Yeah, that's interesting you say that. But part of that is also, if I feel like if they didn't have the sort of strict rent controls, right? And those landlords could have had their rents reflect market value, then probably they wouldn't have sold. Right?
100%. I would agree with you. Yeah, because they are only able to increase about like 2%. And that's
so
kind of like side effects of like, good policy that they think they're implementing.
100% right. So I'm not in favor of rent controls, at least as they're currently structured. And I do think they do more harm than good. It's funny you saying that. I've heard that now from a couple people that the demand for single family rentals, and especially in kind of the 905, is just kind of just through the roof. Well, that's interesting because I have a sort of thesis and I'm quite willing to change my mind on this and be proven wrong. But I kind of have a view that apartment rentals, specifically apartments in the big cities, is actually going to be a little weak for the next couple of years. And that, if you look at Toronto, for example, they went from kind of 1% to 6% vacancy rate in the purpose-built rental place or segment. And I don't think that's going to go very quickly back to that 1% level, even as they open the economy, for a number of reasons. But hearing you say that about the single family rental market in the 905 makes me question with maybe I'm wrong on that.
Actually, no, I agree with you. Although I've taken your data and I looked at it, like the condo rents are coming back up. My thesis on that is the rents are going back up because the people who want to live in the city, who have to live in the city, are just upsizing and to lock in the lower rent. That's where I think most of the transactions are. So when we lease out condos, a lot of the time are people moving into a bigger space. So when we lease out like a bachelor's, we have almost zero interest unless it's like the lowest price. So that's my thesis. So when we kind of see the movement from the 905 or some people from the condo market to the 905 single family low rise stuff, I think there's a need for space given what has happened in the last like year and a half. So I think that's what's driving a lot of people to that space. So I agree with you that I think apartments will take some time before they go back to the 1% vacancy rate. Because smaller size will take time to get filled back up.
Okay, that makes sense. And I want to be clear on that. When I say that I think it's going to take a while to get back, like I mean like the really frothy, tight rental market we saw in 2019. Like I think it'll be a couple of years. So next year at this time, we're going to see big rent growth on a year-over-year basis, just because we're lapping, like we're going to be lapping the minus 20% that we saw early 2020, right? And you just don't really get many, it's pretty hard to see, another decline off minus 20. So you're going to see a big jump off of though, just from base effects off that alone. But in terms of getting back to like the absolute rent levels that we saw before the pandemic, that could be a 2023 story. Like it wouldn't surprise me if it took a while to get there.
2 to 3 years. 2 to 3 years.
Yeah.
Yeah. I think it's going to have to be people move back in. The productivity is really, really bad. And a lot of people have to be forced back into offices and then kind of go back to normal where like I've always believed that humans have very short memory span. Like if you blink a couple of times, you're like, oh, I forgot that happened already. So I think we need to blink a couple of times and then, the pandemic's behind us and we'll go back to normal. But
100%.
It's going to be some time, I think 2-3 years.
Yeah, I think you're totally right. It's funny because there is a narrative out there that so much of the shift that we've seen is going to be permanent. And I think there's an element that will be, right? Like I think that, yeah. Like I think that, I've heard, this is not my thinking, but I've heard people say that COVID's sort of been an accelerant. And I think that's absolutely right. So if you picture, okay, the work from home, was it a trend that was increasing over time to begin with? Like, yes, it was, yes. Right? Yeah. So are we going to go back to exactly how it was after the pandemic? Like, no, like you've probably pulled forward 10 years of that trend, right? Yeah. So if you had, 2% of the population of the workforce that was working from home and it was growing at whatever, half a point a year, whatever it is. Yeah, maybe you go back and it's like, we go from 30% back down to like 7%. It doesn't go back to, I'm making those numbers up, but you get the idea. Like you've pulled forward like 10 years of that trend, I think, through COVID. But the other thing to keep in mind is like this idea that no one's going to be going back to the office is insane to me, right? Yeah, because all you're going to take, like if you picture like and no one's going to be doing business travel is another one that just cracks me up. It's like you give it a little while and everything's going to be normal for a while, but then you're going to get some young, hungry kid that's like, hey, wait a minute, if I go and visit that person and take them out for drinks, take them golf, whatever, I have a better chance of making that sale. Well, all of a sudden that guy starts making the sale and everybody else goes, well, crap, if he's doing that, and then you're right back to where it was. And that's exactly where it's going to be.
Here's my other take on it from a big time kind of like HR person in a big company that I know. So when we're working on them, he's like, I'm all in on the downtown space now because I know we're going to come back. And my pitch to the company, like to the board members was, look, if everyone wants to work from home, right? Why are we hiring local Canadians? Why don't we just outsource to and have some currency arbitrage? If your job
that's a scary thought. Yeah,
it is,
that's
right?
a scary thought. Actually.
But he brought it up, right?
Yeah.
And I'm just like, crap, right? I'm like, if that happens, like you got to watch out for your job security, because like, when I was younger, there's this weird thing like, when you're attached to like a 9 to 5, you got to look like you're busy, right? So I learned really quickly, you just got to look like you're frustrated all the time, like you're working on it,
Yeah. That's right.
Can't figure it out. Yeah. And if you can't look like you're frustrated, right, in offices, aren't you expendable? You're not working on anything. And that kind of idea propagates in your manager's mind, right? So why are they hiring you? Why don't they outsource? So it's scary. And if people believe that because, it's kind of frothy and it's cool to do it right now, like people are going to be in for a surprise in the next few years. Cause like I'm talking to the higher up people. I'm like, this is coming down. Like it's not going to be permanent.
So that's interesting you say that. So when I think about, okay, what concerns me longer term with the Canadian economy, there's a couple things. One is that we are investing. So if you think about like, normally you have so much investment in businesses and then so much investment in housing, right? And ideally over time, the investment in the businesses are what creates the productivity growth and then eventually the income growth to sort of sustain house prices over time, right? Right now in Canada, we're just investing so much in housing relative to business investment. It's actually quite scary. So one of the points that I make, and it's sort of a crazy stat, and you can make of it what you wish, but if we look at just real estate transfer costs, which is like the tax.
Is that your data?
Yeah, that's me.
Okay, right? I saw it.
And I'm not trying to throw shade, and I want to be clear.
No, it's okay.
Right? So like, I'm not trying to throw shade at real estate.
I will finish the sentence for Ben. It's real estate commissions are 1% of GDP. It's stupid.
Well, it's actually crazier than that. So,
is it?
So yeah. So here's the right way to frame it. If we look at, and this is not just real estate commissions, but it's all everything associated with transfer costs, the legals, the transfer taxes, all this stuff.
You're just sugarcoating. Real estate is a big component of it. For sure.
It's a huge component of it. For sure it is. But if you look at, okay, you put in one bucket those expenditures, and you put in the other bucket all research and development expenditures by all companies in Canada. Okay.
Yeah.
The real estate expenses last quarter were 5 times the R&D.
Yeah,
5 times.
It's so ridiculous. Like here, I'll give you some things to back that up. So we have an office of about like 120 agents, right? And I'm not on Facebook too often, but sometimes I go on to help our clients lease out some properties. The amount of people that have reached out to me like, hey, Zen, I just got my real estate license. Can you chat for a little bit? Is insane. The other day I walked into my office. I haven't been there like months, right? Just to like onboard a new team member. And I saw 2 people I've never seen in like 5 years. All of a sudden, they're like, suited up like a realtor. I'm like, oh, I guess you got your license too. It's a thing. It is a thing. Yeah.
Yeah. But what's interesting, okay, so then you think, all right, longer term though, what does that mean for productivity growth? Like that's a concern. I don't have the answer to that, but that's a concern. But what I would say is if you look back through the last 20 years and you look at other countries that have had that same sort of imbalance between housing investment versus business investment, there's really only 3 that are kind of where Canada is currently. And it's basically Greece, Ireland, and Spain in the mid 2000s.
Wonderful.
and it really wasn't a great scenario beyond that for them. Now, I'm not saying that's our future, right? But it's something to be cognizant of. The other thing that concerns me is like, I think we're probably entering a period of time where commodities do really well. So like oil and and copper and all this stuff. And if that's the case, like normally the Canadian currency trades very strong with commodities.
Yep.
And so back to your point, you end up with this situation where because the currency is getting stronger, it affects our exports, but it also makes hiring international labor much cheaper, right? And that's a concern of mine as well, is like the next few years could be a little bit of, I don't know, like we could disappoint beyond that. Like this year, I think we're going to have explosive growth in GDP.
100%.
Maybe even into 2022. Beyond that, I don't know. I have some concerns, but that's me putting my risk thinker on. I always sort of have those concerns.
See, I agree with you, and I always think that way. And that's kind of why I always like, look, you need cash flowing, good fundamental cities to buy properties in, right? To mitigate that risk. Like long term, I'm very, very bullish, but like short term, like what is the government or what shenanigans are going to happen that's going to throw a huge wrinkle into like my clients and myself, right? And circling back to the investment in housing and everything, like I completely agree with you. Like it's unsustainable. If everyone is going to stop what they're doing and just get their real estate license, it's not going to be good. There's no diversity in growth and like kind of our entire GDP, right? And when I start looking at kind of like where it's going to go with like the commodities, if it's going to be easier and cheaper to hire outside, and we have to keep our interest rates because we always export to the US to refine our raw goods, then like it's going to be cheap for corporations to borrow. People are only reining in like real estate, and that's just terrible for the economy. There's no diversity whatsoever. Like I think we need policies to encourage Canadian talent, and because Canadian talent is very, very good.
100% agree with you. And I think one of the things that policymakers are going to increasingly be kind of cornered on is, okay, so I know there's a lot of fear about, a principal residence
exemption,
capital gains tax. Yeah. And I was like, listen, you got to understand the politics here. That's suicide, especially ahead of an election.
You're not going to elect it if you knock that.
Yeah. No, but I do wonder if we're going to start seeing more tax incentives to try to incentivize business investment, and some way of maybe trying to squeeze some of the excess investment in housing out. And I don't know exactly what it's going to look like, but it wouldn't shock me if we saw, like, for example, people who sort of serially move, fix up a place, it's a principal residence, they flip it and then they move, and they do that over and over again. Like I would suspect the government's going to at some point look at that and be like, well, no, that's a business. You shouldn't be getting a principal gains exemption.
They've already started. I've had some clients got audits for moving 3 times in 5 years.
Oh, that's interesting. Yeah. So like, I think you're going to see that become official policy. It also wouldn't shock me. Like we're kind of in an era right now where it's very popular to kind of like try to eat the rich. And I think if you're going to see like an elimination of capital gains exemptions, I would think it would start at kind of the ultra high end, whatever, over 5 million in value, and they'll put a lifetime limit on capital gains at $1 million, and then above that it gets taxed as income or something.
Yeah, it's 100% going to come. I know it already. Like I just anticipate everybody. Like one of the things that I've always noticed is like anyone who has some money, it's always like, well, you don't want to pay taxes, but you're making money. You should pay taxes, right? Like pay your fair share. So if you're making good money, just like you should be taxed on it. And it's 100% coming because you already see like, was it the federal budget where you have an extra tax now if you buy $100,000 car?
Yeah.
Yeah. So like it's coming. Like, you know, it's
100%.
coming.
Yeah. That's right. That's going to be a big theme, I think, for the next 10 years is
100%.
trying to, we do have a real issue. It's not as bad as in the US, but we do have a real issue in Canada with income inequality, right? And there's going to be a big push in the next decade to sort of level that playing field. It's going to take a lot of forms. I think you're absolutely right. But I'm with you. It always frustrates me, like as a business owner, I don't play any shenanigans with my taxes. My daughter had some pretty major surgery when she was a baby. And so like I so appreciate just the expertise in our health system. I know it's not perfect, don't get me wrong, but like when you need major surgery done, especially when you're dealing with kids, having world-class doctors there, like an operation that, on our own probably would have cost us, I don't know, $250,000 if we were in the US. Like, it's just crazy. So stuff like that, like you do appreciate Canada from that perspective. And it absolutely irks me. We have some, this just drives me nuts. I won't get in, but I know where it's clear that they're doing things to avoid taxes. Drives me crazy. But anyway,
like, there's a reason why like everyone wants to come and buy a house in a good school district, because school is free here until university. Like if you ever go to any of the Asian countries, like school is so expensive. You thought daycare was expensive? You have to do this for like 15 years just so they can make it to university.
That's crazy. Yeah,
it's so crazy.
We do take that stuff for granted. For sure.
Yeah, I think so. So like taxes, I'm cool with. Like, it sucks you have to pay it out, but you know what? If you're making money, you should be remitting it. That's my theory on it.
I'm with you 100%. I'm with you on that. I don't love it. I love it as little as the next guy, but when you want those services, you thank God they're there, right?
Yeah, no, I 100% agree. Okay, let's change paths a little bit. Where do you think the real estate market is heading in the next short term? Call it 2-3 years.
Are you talking Toronto specific, or where are we talking?
Let's do Toronto, like GTA specific, just because most of my like audience is GTA.
Yeah, well, I mean, I think we're set up for a scenario where we're going to see a very solid market for the next little while. I think that we've probably pulled forward some significant demand, so it wouldn't shock me if by the time we get into next spring, we're seeing like just sales that are maybe a little softer than they are this year. It's hard to know at this point, but I would be surprised if we hadn't pulled forward some demand. One of the big unknowns is going to be how quickly immigration comes back.
Yeah.
And I've written about this extensively, but I keep highlighting, like, you can't just look at the federal immigration targets and go, oh, 400,000 is what they're targeting this year. That's a record high. Therefore, we're going to be at record high for population growth. Like, it really does not work that way at all. And I won't get too far into the weeds here. I mean, I'm happy to if you really want to, but when you understand the inner workings of how population growth operates in Canada and the various programs, it's quite clear to me that even if the government hits those targets, you're not going to be at record population growth. You're probably not going to be anywhere close to it for a while. And so, that gets back to my view that I think the rental market will probably be a little softer, because I think it'll probably affect kind of rental demand for a while. But look, at the end of the day, we still have a shortage of single family supply. I mean, I did the math on this. This is in that last note, the Edge report that I put out. It's actually going to be the contents of the infographic for this coming month. But if you look at you go back to the 70s and you look at it by decade, and you look at how much population growth increased in each decade and how much single family completions there were in each decade. What's very interesting is like 70s, 80s, 90s, 2000s, generally you're adding about 3.1 million people to the population each decade, and you're building somewhere around 1.3 million single family homes on average.
Mm-hmm.
Okay? 1.2, 1.3. Then you get in the 2010s. You go from adding 3.1 million to 4 million people coming in between 2010 and 2020. And rather than building 1.3 million single family homes, you only build 1.1.
So now we got a spread of like 1 point something million missing homes.
Right. So, well, the right way to think about it, I looked at it. It's like, okay, so we built basically, it's a funny way to think about it, but it's like 0.45 single family homes for every person we added to the population through the 70s to the 2010s. Okay? I know it's kind of a silly way to think about it, but you built effectively 1 home for every 2.4 people added to the population. Okay. All of a sudden you get into the 2010s and it dropped to like 0.25 new homes built per person. So it's almost 4 people per single family home. So the ratios just get out of whack. And so, if we wanted to keep those ratios in line with what they had been for the prior 40 years, we would have had to have built almost 600,000 more single family homes across Canada.
Yeah.
Right. And that's a big issue. So I don't see that that's going to resolve anytime soon. Now, that said, it's really hard to, when you start lapping 35% year-over-year growth, like this time next year, when we're starting to kind of gap over this crazy period that we're seeing right now, pretty hard to imagine you're going to see growth like this again, right? So it's probably going to be much, much more muted. It wouldn't shock me if you get a bit of a pause while the market kind of catches its breath. But everything looks solid. I think the economic backdrop looks very good. I think the interest rate backdrop looks very good. Although I would say, if there's one risk to the market, it's that there is going to be an inflation scare this year, and we'll see how much that affects mortgage rates. It could be material, but I'm not super concerned about it at this point, but it's something to watch. But outside of that, I think it probably looks like a pretty solid year.
I agree with you in a lot of your perspective. Let me run something by you. So if we're building, call it one home for every 4 people, right? Because I came here when I was 5, and I still retain some of my like Chinese heritage and culture, and I still talk to them. So I know how life is in China, right? Everything is multi-generational family. So the pocket in York region I live in, they're like really, really big homes. And I'll say like, we have a stupid large home for the fact that's just my wife and I. And when I go, take my dog for a W, I can't say because you're the freak out right now. When he goes for a WALK, right? It's multi-generational. So you got the grandparents, the parents, the kids, and even sometimes the grandkids, right? So if you're building one home for every 4 people, that actually kind of makes sense if you take into that type of demographic, right? Because in Western culture, it's very used to like, oh, I don't want to live with my parents, right? Granted, like my parents don't live with me, but you want to move out. So if we take the kind of Eastern kind of mentality on how we approach housing, and they can pool their money, wouldn't that just add to the thesis that prices could go up, and maybe this supply crunch is enough for only those type of demographics, but not enough for people who want to live on their own as a single generation?
Yeah, it's an interesting view. There's maybe something to that. The one thing I would say is if you look at the cohort of like millennials and Gen Xers here in Canada right now, you've got a big group of them in that prime home buying cohort of kind of call it 25 to 40.
Yeah, I agree.
And it's actually a very strong group in terms of how it's going to grow over the next few years. And I would say, you'd know much more about that culture than I would, but in general, I would say the cohort here in Canada, I would think they primarily want their own place, and the dream in Canada is still single family.
Right? I agree with you, but if it takes even a percentage of that culture, I'm not saying we're building enough. Like 100% agree, we're not building enough, but for prices to go up, wouldn't it just make sense if people like different generations pool their money, right?
Well, I think we're already seeing that, right? I mean, I do think to some extent, almost certainly we've seen an increase in intergenerational wealth transfer that's helping to support, like, in getting first-time buyers into the market, right? And not only that, but there's big uptick when I talk to people in the mortgage space, big uptick in multiple guarantors on a mortgage, right?
I see it, yeah.
And so in a sense, it's almost the same dynamic, right? It's maybe they're not living under the same house, but they're sort of pooling the resources to make it happen, right? Or even the parents are backstopping the mortgage, right? Yeah. It's the same. It's sort of a similar dynamic, and I don't know when that ends, and I do wonder sometimes, like, that dynamic works as long as house prices keep going up. It's almost like house prices going up provide the fuel for house prices to keep going up. You know what I'm saying?
Exactly.
And I do wonder if that's like a reflexive loop. Well, what does that look like in a downturn? But I don't know. I don't feel like that's a story for this year, and probably not for next. I don't know.
But I've always thought about that too, like from like a critical thinking perspective. It has to stop based on how much your incomes can qualify for, right? So if as an average, the income isn't increasing sufficiently enough for relative to prices, right? Which I know it's a popular belief, then you can't keep having prices go up, even though if your parents are giving the money for the down payment. So at that point, then if you can't buy something, I was thinking about this too, like, how's it going to allow people to buy more? And the only things I can come to is you reduce interest rates, you increase amortizations, or like you just find different ways to stretch out your loan. Because we used to have 40-year amortization if, you know, anyone had a home back in
I think you may go back to that. Like, it wouldn't surprise me. I think the mortgage and building industry has a pretty compelling argument that limiting first-time buyers to 25-year amortization on insured mortgages is arbitrary and probably overly restrictive. Right? 30-year amortizations have worked forever in the US.
Yeah.
I don't think there's, you know, we had them forever here. It wasn't the end of the world. It wouldn't shock me if they go back to that. Mortgage rates going much lower. I got to be honest. Like, I've been in the consistent, I mean, you haven't known me for that long, but I've been consistently in the disinflationary camp. Rates are going to go lower. They're going to go lower. They're going to go lower. And I kind of think that game is played out. I know Europe's got negative rates. I don't see it coming here.
I don't think we'll get negative rates.
Yeah, like I think we're probably at the lows or slightly past them already. It wouldn't surprise me if what we saw earlier this year were the dead lows in rates for a generation. Would not shock me. But I don't think they're going substantially higher either. I'm with you on that. But I don't know. Like, one of the things that I wrestle with though is, okay, so when you talk about affordability, like in terms of housing carrying costs as a share of income, we're already pretty much at the highs. And you're back to like, yeah, like if you go back to like the 1980s, the last time there was a real kind of housing downturn, we're pretty much back to those levels. But there's a key difference. And this was actually the infographic from this past month, which was looking at the share of mortgage payments that go to principal, right? And today, if you take out a mortgage at prevailing rates, so if you're a prime borrower, basically almost 65% of your very first mortgage payment is principal. And so if instead of looking at just the overall carrying cost, if you kind of net out the principal repayment and you sort of say, okay, well, that's just like, all that is a transfer on the balance sheet. It goes from my income and it just becomes an asset, because even though I'm paying off my mortgage, it's just immediately going to building equity, right?
Yeah.
If you net that out, then actually affordability is not horrible in the long term, not from a long-term perspective.
But that's funny you said that. That's the infographic I shared with my team this week, right? And it's a very interesting take and look at it. But the problem I find is, even though it makes sense from an affordability standpoint, your stress test and your income in order to qualify for at these new high price points is kind of the entry to play the game. And if you don't have the income or the down, then you're royally screwed. Like, I can justify it if I make the money, right? But if I don't to get into the market, ouch.
But you know what? I 100% agree with you. That's been an issue for years, right? Like, if you look at it on like, how are people coming up with all of these massive down payments for years? Like, how are first-time buyers affording this at all? And yet they just do. It's like, it's Canadian home buyers. It's like liquid. They just find the path of least resistance and they just kind of make it happen. So I don't have a great answer for that. I think in theory that we should have seen affordability constraints start to affect demand by now, and they just kind of haven't. So I don't know, if rates rise a little bit, if prices rise a bit more from here, but I don't disagree with you. Like, I do think, I said before, it's pretty hard to lap this. I don't think this point next year, we're going to be talking about 35% year-over-year appreciation. And
no, 100%. I would be surprised if we have more than 5.
Yeah, I think that's totally, and it wouldn't shock me even this time next year if demand is a little soft and maybe you see a bit of a consolidation for a while in prices. Like, none of that would shock me. Right. But it would very much shock me if we're talking about another 30% off of these levels.
No, there's no way that's possible. Like, anyone who's selling you really. Okay, yeah, fair enough. Okay, okay, yeah.
Let's go back to CMHC in 2020 last year.
Yeah.
No way. Well, this is Canada.
Yeah, I guess when you kind of look at these things, this is why we're saying, like, you got to watch out for what can happen in the short term. But I think long term, as like an asset to hold, it makes sense. Like, it makes sense.
Yeah.
So I you know what the crazy thing is? Like, I think it was from your data, like the inflation, or not your data, the CPI, the Consumer Price Index. They're saying shelter's up 3.2%, but like, that's a very rigged way of looking at it.
It's so bizarre.
I can see it. It's triggering you. Okay, you go.
Don't get me started. Okay, so here's the issue with that. So there's kind of two components to the shelter component in the CPI. It's like the replacement cost and the carrying cost. Now, this is what's so perverse about it. Is like the replacement costs are up huge. It's like up 12% because, of course, price of lumber and everything. Look, even that's probably understated. Do you want to hear a really
crazy story? So for everyone who doesn't understand, I've been talking about replacement costs for a while. which is like what the insurance is going to say it's going to cost to rebuild your home. And that's what they have to insure against, right?
Yeah.
We've bought properties this year where the replacement cost was higher than what we purchased it for.
Yeah, totally. Well, that makes total sense, right? But even, okay, so my point is, even if you, let's grant Stats Canada some credit, and we'll say, okay, yes, you actually could build a house for 12%. I think that's a gem. The bigger issue is on the carrying cost side, that's actually a reflection of interest rates, right? And so their view is, well, interest rates are down, so actually the carrying costs are falling. So when you blend, high replacement costs but much lower carrying costs, you end up with like 2 or 3%. The issue is, if you ever get into an environment where the Bank of Canada has to control inflation, they start raising rates. Well, those rising rates feeds back into the carrying cost component of shelter, and it's a cyclical loop. So it feeds back into higher CPI, right? So they have to tighten more, right?
Which is all
it's a really bizarre, like it's such a bizarre way. Like them cutting rates artificially pushes down CPI. Like it's just a stupid way to think about it.
It makes no sense, but this is all the more reason we keep saying interest rates can't increase that much more.
I totally agree with that. Rates will be low for a while. I completely agree.
And you know, when like your CPI explanation makes total sense, because if you're measuring things as a percentage of your, call it monthly income, your debt service ratio from the mortgage side, right? Like at the minute you lift the stress test, right? People are able to, buy more, or if you stretch your loan like amortization more, you're able to buy more. So like those are kind of like the key levers I'm just watching the government to do. Like right now, the talk is about things are unaffordable. We're going to let it ride out. But once things kind of like, they're like, oh, we can't buy anything, things are too expensive. Are you going to push the other levers and kind of like loosen up credit? Because credit's the biggest driver for real estate.
I agree with that. I think they probably will, to be honest. I think that, again, it's hard to argue that some of these arbitrary lines in the sand around amortization for first-time buyers, it's hard to justify. The other thing to keep in mind, just if you kind of sniff the political winds, like you have a different administration now at CMHC, and I don't know. So Evan Siddall is now retired. Evan Siddall was kind of like the bane of the housing industry for years.
He's a great Twitter fellow.
Yeah, he is, and he's not shy about his opinion. I actually really like the guy. I know he's kind of loathed in certain real estate circles, but he did his best to sort of de-risk CMHC and bring about all these very tight underwriting policies. You have a new CEO in place, and I don't know, her name's Romy Bowers, and I don't know enough about her and her background to know kind of how she leans on this stuff, but I have to think she's going to be less conservative than Evan Siddall, and that could play back into some of this exact dynamic that we're talking about. Like I would not be surprised at all if we saw them loosen first-time buyer guidelines.
I think they have to. I mean, like we just strictly talked the political swing point, right? Like the first time, call it our generation, millennials who are home buyers are also going to be the biggest voting cohort too, right? So there has to be some kind of, lobbying for the votes in that manner, not to get too political, right? So if the biggest complaint is first-time home buyers can't build, what if they just raise the amortization to like 40 years, 45 years for anyone who doesn't own a home?
That's not a crazy proposal, right? Like I've heard that brought up, like what if we just made it that if it's your first home, you extend it out to 40 years, the moment that you upsell or buy another place, you're confined to kind of a standard 30 years for an uninsured, right? But for your first time, just getting the foot in the door, look, it's not an insane proposition. I've heard that come up from the home builders, and I think from the mortgage lobby. It's not crazy. It's hard to push back against that. Right?
Okay. I thought I was crazy, but okay, all right. I'm glad some people.
Oh, that's out there. That view is out there. I don't know if they went out to like 45 years, but I think that at one point they were kind of pushing for 30 or 35 years. But it's not a crazy. I mean, it's not. Look, it's not going to do anything to prices. It'll help push prices up, if anything. So it's not from a price. If you view affordability in the sense of like headline house prices, it's not going to help prices go down. If anything, it'll do the opposite. But it will make the carrying costs easier for those first-time buyers.
I've done the math before, right? Because we had like 40-year mortgages before. I think every 5 years, you basically get another like 10% reduction in your total debt service ratios, right? Yeah. So like, let's just, it's not the proper math. Some mortgage brokers are going to comment below and say, you're wrong, you're an idiot. But let's just say you do that and you can afford 10% more. And you go to 45 years, you can do 10% more. That it's not even going to cover the kind of lift we got of 30% in the last year. So like as much as it helps, I just don't know how much it helps.
It's not. At the end of the day, I do think I think what's going to be needed in the longer term is at some point the government has to sit down and reevaluate their immigration policy. And I know as soon as I say this in Canada, the moment you talk about immigration policy, it's like you feel these like judgmental stares. It's like taboo in Canada. But the reality is this.
On your background, though, that's why.
Right. If it's me talking about, you're 100%.
I can say it. You
can say it. 100%.
There's too many of us here.
Right. But here's the reality. Like, and I want to be totally clear. Like, the immigration policies are good from a long-term perspective. I'm 100% in support. What the government needs to do, though, is sit down with the municipalities that are ultimately doing the urban planning and ensure that their plans will accommodate all the people that they want to bring here. Because that, I would say that was the big failure. If you go back in like 2018, 2019, we had a nominal population growth that hit almost 600,000. So in other words, we were bringing, like, population in Canada was growing by almost 600,000 year over year at peak in 2019. You can't build enough to house that many people. Like, we literally don't have enough tradespeople to do that, right? And so that, to me, and a lot of that was non-permanent residents. You saw a huge surge in international students, and that tightened the labor market, or tightened the rental market, did all sorts of stuff. But like, that's an example where I would say that's a policy failure. Like, the government can't put 600,000 more people here without talking to the municipalities about, like, well, how are we going to make this work, right? And so they created all this. It was these unintended consequences of these, the rental crisis that we saw in Toronto that we're still feeling today to some extent, like you're seeing in the single family rental pool. So the feds need to sit down and figure out how they're actually going to accommodate. It's not enough to say, oh, we need immigration because it's good for long-term productivity. Fine. Where are you going to put everybody?
Yeah.
Right? Like, this is a real conversation we need to have.
I think the challenge, from what I understand in the political space, is the housing is controlled by the provincial and municipal side.
That's exactly it.
When the federal comes in and just increases immigration, they need to talk to the provincial and the municipal. It's like, guys,
that's my point.
House these people, right?
Yeah, that's exactly my point. Is the feds can pull the lever on population growth, they can't pull the lever on where they're going to put them. And so you get this mismatch in policy objectives, right? And so they need to sit down with the municipalities and figure out how they can streamline approvals. Like, there's things I think they could be doing to try to expedite that, right? Like, I don't know, maybe like, I do wonder sometimes if when you get into these really frothy markets, if it's, holding on to vacant land just becomes a call option, right?
100%.
And so it's almost as profitable and easier to just land bank than it is to actually build. And I don't know to what extent that's happening, but I mean, that's one thing where I think, like, if you've got developers that are sitting on land that's already been zoned for redevelopment and it's not being redeveloped, like, that's something where the government should be like, look, you need to do something with that, or you need to sell it, or you need to pay a higher tax rate on it or something, right? But like, they need to be, if it's meant for new supply and it's not being built, do something with it, right? But also, like, they also just need to streamline the approval process. It's horribly difficult to get anything built in anywhere in the country.
The red tape is ridiculous. I remember when we were doing legal conversions back in the day, it was easy. It was not that cheap. It would take like 2-3 weeks. Now it takes like 6 months to get a permit.
Yeah, it's crazy.
And for my builder clients, it's just insane to get any kind of rezoning, right? You got all your NIMBYs coming here saying, don't build on my backyard. I'm just assuming it's an old person. I apologize. But like,
yeah, it usually is. Yeah.
Yeah. And that makes it so much more difficult. Like, I'll give you another story. Like, before I did this, like, I did a lot of commercial, and we would have builders and institutional clients come to us and say, look, Zen, you need to go find these pieces of land that have building potential, right? Not on green space. And I want you to negotiate the best VTB you can for 10 years. For anyone who doesn't understand this, it's a vendor take-back mortgage, right? So we structured it to the seller as a, look, you can space out your capital gains taxes. Obviously, this is not your primary residence, right? And we'll pay you, call it $100,000 of this property every year, or call it $1 million, right? Like, we'll give you $100,000 every single year. So you have reduced taxes. And now they rightfully own the property, but their carrying costs on the balance sheet for these institutional guys are very low. So that they've been land banking this stuff for a very long time. Like, I can confirm with you 100%.
Yeah.
And that's the strategy.
So stuff like that, I get the incentive, but it doesn't help from an affordability and a supply constraint perspective, right?
And that's why I want to have the chat there. Like, everything we have is kind of like backwards to increasing supply. So when I look at these things, I'm like, how can this be fixed? How can this be fixed? But like, I look at the reasoning and the rationale behind them, like, it's never going to happen. That's why we keep having supply crisis. Yeah,
well, the municipalities at the end, they have to get out of the way, right? It is incredibly frustrating. And I'm I'm sympathetic to some extent, well, to a large extent, to builders that are trying to bring supply and just banging their head against the wall, right? It's one thing if it's a builder that's just sitting on land doing nothing with it. And I don't know to what extent that's happening. It's probably less than maybe I'd be concerned about, but
It's not that
you
much.
know,
Like, that's just a story I can.
yeah. But I mean, again, it's when I think about how do you start to address some of these issues, it's like a bunch of little things that just make sense. And you do those little things first, and then you sort of see where the chips fall, right? And it's like, that's maybe just one of those things that is an easy fix, right? But for sure, getting municipalities on board and just expediting the process and getting rid of red tape is a no-brainer, because they're not helping the situation at all.
Yeah, I'm not going to take up too much time because I know we can chat about this all the time. But there's one thing I put a giant note on my screen here that I need to talk to you about, because it's something I want to get your thoughts on. Money supply relative to pricing, right?
Yeah.
So there's a lot of metrics. I think when you were talking to some other guys, when we were talking, like I followed all the M2 supply, and also was measuring Canadian metro cities, kind of like you do, against the value of gold, like real estate prices, single family homes against the price of gold. So there's a chart that I'll put on the screen. Sorry, Ben, I can't show it to you right now. But basically, if you measure real estate prices compared to gold, which is a good store of value, real estate prices have actually come down in the last 4 years in Toronto. This includes Calgary, Vancouver, Toronto, and Montreal. Prices are down from the peak of 2017. So how would you, I guess, answer my question? Do you think money supply is a bigger factor, given how much money being printed is to the current affordability crisis we have?
Yeah, I have a hard time with some of those straight line comparisons. So for example, like, I don't know many people that get paid in gold, right? So at the end of the day, you still have to make the mortgage payments, right? So unless you're getting paid in gold or getting paid in Bitcoin or some other kind of hard currency, it's an interesting thought experiment. And there may well be something to it. Like, you're right. You've got M2 money supply has grown at last check, I think about 18% year over year, which is about a 40-year high. But you also have to remember, like, how that affects the economy to a large extent is related to how quickly or how willing people are to spend it, right?
No one's
and right now people just aren't spending, right? Because it's still in lockdown. So like, yeah, M2's up, but I track, actually, I think in the last report I had, or maybe it's going to be in this report, looking at M2 velocity, because I track that pretty closely. Yeah. And like, it's ticked up off the lows. Like, how couldn't it? Like, when you're comparing it to March 2020, when literally no one can leave their house, well, of course, people are spending more money, right? But it's got a long ways to go. It's one of the reasons why I think we're going to see an inflation scare, because there's about an extra $115 billion just sitting in checking accounts in Canadian banks relative to kind of pre-pandemic trends. That's a lot of cash that's waiting to get spent. And my read on it is, when they say go, when they lift the restrictions, I think people are going to just spend like crazy. And you're right. I do worry that that's going to create an inflationary spike, or a little bit of inflationary backdrop for a while. And it gets back to what I was saying earlier, which is that I think that from a rates perspective, the government will only let mortgage rates go so high. Not mortgage rates specifically, but bond yields, which indirectly affect mortgage rates. And so I think that you're going to see mortgage rates that are negative in real terms, so below the rate of inflation, for several years. And that's actually a pretty good setup for all real assets, not just real estate, but anything that's bought on credit, right?
Yeah.
And any real asset. So I pay attention to the money supply. I don't love those straight line analogies, like the price gold, like Toronto priced in gold. But it's an interesting way to think about it. And there's probably something to this idea that the money supply is affecting housing over the longer term, for sure.
My belief is that because so many people like love to invest in real estate, and I would say most of my clients have like multiple investment properties, right? That when you're financially well off, you can start thinking about these things. But for the person who's just trying to make ends meet and pay for roofing, it's not something they think about. Kind of like how inflation over time deteriorates what you can buy, right? Like, I remember I used to live across from a 7-Eleven and the gas was like $0.25 a liter, right? Like, so like over time, these things happen. I'm just concerned that, if we continue seeing this debt spiral, like, do asset prices maybe go up faster than normal, right? So rather than the 40-year average of 6% increase in real estate prices, are we going to see 7%, right? So your rule of 72, your assets double even faster.
Listen, that could 100% be the case. I do think we're going to enter into a period of what we call financial repression, right? Which is where the central banks are going to keep rates artificially low because there is such a tremendous amount of debt in the system. We know that. And one of the ways that you fix that is you basically steal from old people slowly, right? Which is via inflation. And when you do that, you end up with a scenario where, the people that are the debtors in society, which tend to be younger people, you inflate away some of those debts and you basically rob the older people through inflation. And that gets back to the point I made earlier about having this wealth inequality. And that's going to be a big story over the next 10 years. I don't know exactly how that's going to play out. Listen, man, we're in a period of just like tremendous uncertainty. And I have no idea, but that wouldn't be the craziest outcome. If you told me that prices are going to be stronger over the next 10 years in Canada than they have been, sure, maybe, right? Like, but I think that would primarily be a function of just financial repression from the central banks, keeping rates artificially low, robbing from old people to try to artificially support debtors and inflate some of that debt away. And that's one of the ways we're going to end up with sort of a deleveraging of the economy.
Yeah, I'm just looking for you to kind of like shoot down my bullish kind of like logical thinking on things, right? Like,
yeah, no, I'm not shooting it down at all.
No,
look,
I
10
want
years
to.
is a long time. 10 years is a long time. Look, I think it's unlikely. I would say if you put a gun to my head and said the next 10 years, are they going to be stronger than the last or weaker? Like, I don't know, man. I'd bank on weaker, but the central banks are going to play a big role in this. And if we get into this financial repression, all bets are off, right? So we're in a period of just like heightened uncertainty, right? Yeah. With so much that's happened. And it's really hard to have a really firm conviction on anything right now. So I think I think what you're doing is smart. You have a view, but you hold it lightly, right? And it's like, you ask people to shoot holes in it, right? Yeah. And I think that's the right way to think about it.
Yeah, it's like the red flagging thing, right? That's why I wanted to chat to you. I'm like, just like, tell me to stop drinking the Kool-Aid, Ben. Tell me to stop drinking the Kool-Aid.
I can't. I think it's, you may well be completely right on this. I really don't know, man.
Yeah. So, all right, Ben, no, I don't want to take up too much time. I appreciate everything you've shared here. Anything you want to plug?
Well, just the site. If you include a link to Edge Analytics, that would be amazing. And to the extent that you have viewers here that are in the real estate professional space, like, come and check it out. It's $30 for a month. I mean, that's, you got to pay to view everything, but you can cancel it at any time if it sucks. And we're pretty easy to fire. So come check it out and let me know what you think. Yeah,
I'll put all the links to edgeanalytics.ca and some of your contacts for like North Cove on the description, and I'll make it flashing on the screen here. But like, I just want to add, like, if anyone who kind of likes the conversation we've had today or enjoys macroeconomics or like trends and just wants to be on top of the curve, because I always tell my clients, like, look, you work with us because we have an information advantage and we're just better than everyone else. That's how you make money as an investor, right? And how I get that information, a lot of it is through Ben. So if you want to have this like information advantage and this edge over everyone else, is that why you call it edge analytics?
It.
Nah, I nailed it. All right. Okay. So you want to have this edge over, all your competition, because as you know, there's one realtor for every 8 people in Ontario now. You should definitely subscribe to Edge Analytics. That's my plug for you.
Thank you. I appreciate it.
Wicked report. It really is. Yeah, it definitely.
Thank you.
Yeah. All right, Ben, I'm gonna take it off now. If you guys have any other questions, you can put them in the comment section below or reach out to myself or Ben. Our contacts will be in the description as well. All right. Until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.